What's going on, everyone? I'm Mike with Penner Investments, and today I'm going to discuss this past week's credit spreads while I wait for an update in the market to buy some SPY puts ahead of the Fed interest rate hike. Please be sure to hit the like button, share this information so others may view it, and also subscribe to my channel so you do not miss out on any future content. On this past Thursday, October 13th, when the market was down, I sold 5 contracts on the Nvidia stock, the 95 strike and the 90 strike credit spread. This brought in $188 for this trade and it expired this past Friday, October 21st. I also sold 10 more Nvidia credit spreads for $288. A nice little credit on Wednesday as well with the 112 strike and the 107 strike prices. And that also expired on this past Friday, which was a 3-day trade. This gave me a total of $476 for this past week, just on the credit spread trades that I did. It's not a huge amount of money, but it's still not bad for just a couple of trades that I did inside of 1 week. These were the only 2 credit spreads that I did this past week. A little refresher on credit spreads. This is the strategy that I use to bring in some income when I have an inclination of where the market will not go, as these are somewhat of a directional trade. The mechanics of a credit spread is that I sell one option and buy another one that's further away from the money, meaning further away from the current price that the stock is trading. The spreads I did here were put credit spreads. The trade on Wednesday, Nvidia was trading around $120 that day. And I did not believe that it would go down much further over the next couple of days, as this was only a 3-day trade. So I sold the Nvidia 112 puts for a credit of 40 cents each, which is 40 bucks. As with options, they represent 100 shares, so you got to multiply it all times 100. I did 10 contracts, bringing in $400 while simultaneously buying the $107 puts for $100. For the 10 contracts, this gave me a total of $300 less the commissions to the brokerage house. Here I'm essentially betting that Nvidia will not go below the $112 strike price, which is pretty doubtful for only a couple of trading days. I like to stay away from credit spreads in a market after the stock has run up, especially when it's a choppy and volatile market like we've had in the past several months. I prefer to do these trades on days that the market is down. This particular trade, the stock would have had to pull back another 6.5% or just over 6.5% in just a couple of days for this trade for me to have the risk of this trade not being profitable. The reason why I like this trade is because the stock can stay flat, it can go up, or it can even go down a little, and I'm still profitable. I do not have to be 100% right on the direction of the stock, which would be impossible to predict. The spread is the difference between the 2 strike prices. The put that I sold at the 112 strike and the lower put that I sold at the strike price of $107 that is further away from being in the money. With the spread being $5, I'm only risking $500 per contract, less the credit that I corrected for selling the contract. Remember, you got to times everything by 100 with options. As I collected $40 per contract, my maximum risk was $460 for each one of these contracts I did. A few points to keep in mind about credit spreads is to not trade more contracts than you can cover, and to not put all your trades in on one stock. You know, if I was going to allocate $10,000 worth of risk for credit spreads this week, I would not do them all on this one Nvidia stock. This way you're protecting yourself from the company coming out with some bad news and having all of your trades that you have losing at the same time. Also, I like to do other trades as well, so I do not have everything for the week tied up in one strategy. I like to incorporate some cash secured puts and covered calls. I sold a few of those this past Friday as well. Well, thanks for watching, everyone, and good luck trading.